Property and Casualty Exam Cost Best Way to Study Guide. Question 1. The amount an insured must pay out of pocket before the insurer pays is the deductible, premium, copayment, coinsurance. A deductible is the initial amount the policyholder must pay toward a covered loss before the insurance kicks in. Question 2. In property insurance, actual cash value, ACV, is defined as replacement cost minus depreciation, original purchase price, current market value, assessed tax value. Actual cash value is a valuation method calculated as the replacement cost of property minus physical depreciation. Question 3. What does the insuring clause outline? The insurer's promise to pay, the exclusions, the policy owner's duties, the grace period. The insuring clause is the core of the contract where the insurer explicitly states its promise to pay covered claims. Question 4. What does a waiver of premium rider do? Waives premiums if the insured becomes disabled, removes the deductible, refunds all premiums at maturity, lowers the overall policy cost. This rider suspends premium payments if the insured becomes totally disabled, keeping the policy in force. Question 5. A policy that provides coverage for a specific period of time is called term life insurance, whole life insurance, universal life insurance, variable life insurance. Term life insurance provides temporary coverage for a specified term or duration. Question 6. Liability insurance primarily protects the insured against third-party claims, damage to their own property, medical emergencies, loss of income. Liability coverage pays damages to a third party when the insured is found legally responsible for injury or property damage. Question 7. Which of the following describes indemnity? Restoring the insured to their prior financial state, making a profit from a claim, paying punitive damages, providing lifelong health coverage. The principle of indemnity states that insurance should restore the insured to the same financial condition as before the loss. Question 8. Which entity ensures consumers are treated fairly by insurers? The State Department of Insurance, the Federal Reserve, the SEC, the NAIC, directly. State departments of insurance regulate insurers locally and enforce laws to protect consumers. Question 9. The transfer of risk from an individual to an insurance company is known as insurance, avoidance, retention, reduction. Insurance is defined as the transfer of pure risk from an individual or entity to an insurance company. Question 10. Which provision keeps a policy in force if a premium is slightly late? Grace period, reinstatement, incontestability, free look. The grace period allows the policy to remain active for a specific time, example 30 days, after the premium due date. Question 11. What type of risk is insurable? Pure risk, speculative risk, guaranteed risk, investment risk. Only pure risks, which involve only the chance of loss or no loss, are insurable. Speculative risks involve the chance of gain. Question 12. What does life insurance primarily protect against? Financial loss from early death, medical expenses, property damage, disability. Life insurance is designed to provide financial protection to dependents in the event of the insured's premature death. Question 13. Which type of authority is specifically written in the agent's contract? Express authority, implied authority, apparent authority, assumed authority. Express authority is the specific, written power explicitly granted to the agent by the principal in the agency agreement. Question 14. An independent agent is distinct because they represent multiple insurers, are employed by one insurer, sell only life insurance, cannot bind coverage. Independent agents are not captive to a single company, they represent multiple insurers and can shop around for clients. Question 15. The person who receives the proceeds of a life insurance policy is the beneficiary, insured, policy owner, agent. The beneficiary is the individual or entity named in the policy to receive the death benefit. Question 16. A morale hazard refers to carelessness or indifference, dishonesty, physical defects, occupational dangers. A morale hazard arises from a state of mind that causes an individual to be careless, thus increasing the chance of a loss. Question 17. Which health insurance policy feature prevents overinsurance? Coordination of benefits, exclusions, grace period, incontestability clause. The coordination of benefits, COB, provision ensures that multiple policies do not pay out more than 100% of the medical expenses. Question 18. Which of the following violates the principle of utmost good faith? Concealment, underwriting, indemnification, subrogation. Concealment is the intentional withholding of material facts, which violates the utmost good faith expected in insurance contracts. Question 19. Comprehensive coverage on an auto policy covers which of the following? Theft or hail damage, collision with another vehicle, medical bills of the other driver, damage to public property. Comprehensive, or other than collision, covers non-collision events like theft, fire, vandalism, and weather damage. Question 20. An agreement that gives an agent the right to represent the insurer is agency agreement, binding receipt, insuring clause, fiduciary bond. The agency agreement, or contract, is the legal document that authorizes the agent to act on behalf of the insurer.